Welcome to the Deep Dive. Today, we're really zeroing in on Adani Enterprises Ltd, AEL. It's the flagship company of the Adani Group.
Right. And for anyone following India's infrastructure scene, AEL is, well, it's known as this major business incubator.
Exactly. Their core focus seems to be building out these essential infrastructure and utility assets, logistics too, and also core metals and mining.
All pretty critical areas for India's growth, tackling challenges in logistics, the energy transition, and just overall productivity.
And what's really interesting is their history, isn't it? They have this proven track record of nurturing businesses and then spinning them off.
Yeah, big names came out of that incubator. Adani Ports and SEZ, Adani Energy Solutions, Power, Green Energy, Total Gas, Adani Wilmar.
Quite the list. So our goal today is to really get under the hood of their latest performance. We're looking at the Q4 FY25 results.
Right. We'll be dissecting those financials, pulling at the key highlights. We've got their earnings call, the investor presentation, the media release.
So pretty solid base of information for this deep dive.
Definitely. Gives us a comprehensive view.
Okay, so kicking off, a couple of immediate positive signs, the credit ratings. Both CARE and ICRA have bumped AEL up to AA.
That's a strong signal, yeah. Reflects positively on their financial standing.
And looking at the full year, FY25 consolidated results. Income reached 1,365 billion. That's up just 2% year on year.
Modest on the income front, but look at the EBITDA. A big jump there, 26% increase to 167.22 billion.
Right, and profit before tax, PBT, also saw a healthy growth, up 16% to 65.33 billion.
We should probably add a bit of context to that PBT number, though.
Ah, yes, the Adani Wilmar stake sale.
Exactly. There's a realized gain of nearly 40 billion, 39.46 billion, to be precise, baked into that PBT figure from selling that 13.5% stake.
Good point. So a significant one-off event boosting the bottom line for the year.
Absolutely. But even setting that aside for a moment, the really compelling story seems to be within their incubating businesses.
The ones still being developed in-house.
Yeah. Their combined income is now basically on par with AEL's entire income for FY23.
Wow, okay. That really puts their growth into perspective.
It does. For FY25, these incubating units saw their income jump 42%, hitting almost 346 billion.
And the profitability.
Even stronger. EBITDA surged 68% to just over 100 billion, and PBT nearly doubled, up 87% to almost 50 billion.
That's impressive momentum. Are there specific incubating areas driving that?
Definitely. The green hydrogen ecosystem, for one, its EBITDA climbed, get this, 108% to nearly 48 billion.
Huge jump. Likely reflecting progress and maybe early demand?
Probably a mix of both. And the airport business is another strong performer. EBITDA up 43% to about 35 billion.
Okay, so what's that, like a run rate of around 10 billion per quarter for airports?
Roughly, yeah. Seems like a steady contributor now.
And they're not just focusing there. We're seeing expansion plans in solar too, right? Another 6GW cell and module line planned?
Correct. Adding significant capacity there. Plus, they've upped their wind turbine manufacturing capacity from 1.5 GW to 2.25 GW.
So really investing strategically in building out that renewable energy manufacturing base.
Seems like it. And alongside that, their sustainability focus is getting sharper. Their CDP/CC rating got upgraded to A for 2024.
Which puts them in the leadership category for emissions reduction.
Exactly. And they also got a strong rating score of 67.5 from ESG Risk Assessment and Insight. These things matter more and more to investors.
Definitely. Okay, let's switch gears a bit to the more established operations. Mining services.
Right. They hold 13 contracts, mostly coal, a couple of iron ore. Dispatch volume saw a really big jump, 40%, hitting 43.3 million metric tons.
And that translates to revenue.
Big time. Revenue up 60% to nearly 38 billion, and EBITDA basically doubled to almost 17 billion.
So strong performance there. And the Parsa coal block is running well.
Yeah, operating near its rated capacity of 15 MMTPA, according to the update.
Okay, now what about the integrated resource management, the IRM business?
Ah, yes. The picture there is a bit different. Full year volume was 56.5 MMT, generating a solid EBITDA of around 36 billion. But specifically in Q4 FY25, the IRM volume dropped significantly, down 38% year on year.
Ouch. So that likely pulled down the performance of the more mature segments a bit in the last quarter.
Seems like a fair assessment, yeah.
Okay, let's dive into those segments in more detail then. Airports first, AAHL. What did we see in Q4?
Passenger traffic showed decent growth, up 6% year-on-year in Q4, about 24.7 million passengers.
And for the full year?
Full-year growth was slightly better at 7%, bringing the total to 94.4 million passengers across their airports.
Okay. What about plane movements, ATMs?
Also up, 3% increase in Q4, 5% for the full year FY25.
And cargo?
Cargo was flat year-on-year in Q4, interestingly, but for the full year it did increase by 8%, reaching 10.9 lakh metric tons.
Right. And you mentioned the airport EBITDA earlier. Mumbai Airport plays a big role there, doesn't it?
A huge role. Roughly 45% of that nearly 40 billion airport EBITDA comes just from Mumbai. Really underscores its importance.
Definitely. And it's encouraging that all 6 of their PPP airports are now apparently hitting EBITDA break-even.
That's a significant milestone for that portfolio, yeah. Shows they're getting operational efficiency right across the board.
They also added new routes and flights during the quarter.
Yeah, 12 new routes, 8 new flights should help keep that passenger growth going.
And Mumbai Airport got a diamond rating for emission reduction efforts. Good to see that recognition.
Absolutely. On Mumbai, there are also future plans to watch. A phased redevelopment is underway.
Right. And the expectation is that traffic could eventually pop 100 million passengers a year.
That's the long-term potential they see, especially once Navi Mumbai Airport is up and running and Terminal 1 gets its upgrade.
And they clarified the Terminal 1 work won't hit overall revenue potential.
Right. Management framed it as more of a timing difference within the regulatory asset base, not a reduction in value. Basically, how and when they earn returns on that asset.
Got it. And speaking of Navi Mumbai, Phase 2 is planned right after Phase 1 stabilizes.
That's the plan. And Phase 2 is a massive expansion, taking capacity from 20 million passengers up to 60 million.
Wow, that's a huge jump, a real game changer for the Mumbai region's capacity.
Definitely. And, they also shared some operational KPIs in the presentation.
Oh yeah, like wait times.
Exactly. Security queues, integration, car park, check-in for several airports like Ahmedabad, Lucknow, Mumbai, Jaipur.
And how did they look?
Generally pretty good. For Jan, Feb, March, most metrics were hitting that 95% benchmark for acceptable wait times. Shows a focus on the passenger experience.
Good to know. Okay, shifting from air to ground, the roads business, ARTL. What's happening there?
Serious acceleration in construction. In Q4 FY25, they completed nearly 700 lane kilometers.
Compared to?
Compared to just under 285 in Q4 the previous year.
Big difference, and the full year.
Even more stark, over 2,400 lane kilometers in FY25 versus just over 500 in FY24. They're really ramping up execution.
So their project delivery seems to be hitting its stride. How many projects do they have?
The portfolio has 14 projects, 6 are operational, 8 are under construction, mix of HAME and BOT models.
Any notable ones?
Well, there are projects listed like BPRPL in Chhattisgarh, SKRPL in Telangana, and the big one is the Ganga Expressway project in UP, which is a BOT project, so diverse geography and project types.
Okay. Now let's circle back quickly to mining services. We saw the strong full-year growth. Q4 kept pace.
It did. Dispatch volume was up 30% year-on-year in Q4, reaching 14 million metric tons.
And they gave some detail on which mines are contributing.
Yeah, the presentation breaks it down. PKB, Garapalma III, Talabir II and III, Parsa. Gives you a sense of where the volume is coming from.
And management is optimistic about future volumes.
Seems so. They mentioned potentially hitting close to 60 million tons over the next 18 months, assuming current demand holds.
Right. Now, the IRM business, integrated resource management, we touched on the volume decline.
Yeah, worth stressing again that the 38% year-on-year volume drop in Q4 definitely impacted that segment's financials for the quarter.
Okay. Let's turn to Adani New Industries Ltd, the ecosystem focused on future energy and manufacturing. How did they fare?
Pretty strong progress there. Module sales were up 24% in Q4 and a hefty 59% for the full fiscal year.
And wind turbine generators, WTGs.
Also solid growth, up 28% in Q4 and actually doubled year-on-year for the full FY25.
So clearly building momentum in renewable manufacturing sales.
Definitely. And they're expanding capacity too. Wind turbine manufacturing is up to 2.25 GW annually now, with 4 listed models. They even picked up an ICC Green Energy Award.
Nice. And a big solar expansion.
That's underway. Construction started on the additional 6 GW cell and module line. They've secured $55 billion in financing for it.
And that's on top of the existing 2 GW line.
Correct. The existing 2 GW line is operational. This new line is expected around FY26, FY27, all part of their bigger plan for a 10 GW integrated ecosystem.
A major bet on solar manufacturing, then.
Absolutely. Shifting to digital infrastructure, the data center business, Adani Connex, ACX, any updates?
Steady progress. Phase 2 of the Hyderabad Center is done. Noida is built and now operational with an initial 10 milliW capacity.
And
Construction is well advanced there, too. Pune Fort is around 78% complete for Phase 1, Pune 2, about 89%. So building out that network, right? And one more industrial piece, the copper smelter.
Right. That's a significant new development. It's been commissioned.
Commissioned, but not yet at full production.
Correct. They expect to ramp up over the next 180 days or so, should reach full run rate around Q3 of the next fiscal year.
And how will that impact financials initially?
They expect to start reporting segmental results, including copper, around Q4 FY26, but mention it won't be hugely material to AEL's overall results at first. And they also noted they'd been conservative in their initial EBITDA and cash flow estimates, already factoring in potential TCRC fluctuations.
TCRC being the treatment and refining charges.
Exactly. Suggests some prudence in their forecasting for this new venture. They did mention working capital in copper saw an increase, though, from about 10 billion to 15 billion rupees.
Okay, interesting. Let's pull back and look at the overall financials again, specifically Q4. Income up 19%.
Yes, 276 billion. And EBITDA matched that growth, up 19% to 43.5 billion roughly.
But PBT was relatively flat in Q4, excluding the Wilmar gain.
Right, about 13.1 billion versus 13.2 billion the previous year. That exceptional gain from Wilmar, the 39.46 billion pre-tax or 32.86 billion post-tax, really needs to be separated to see the underlying operational trend for the quarter.
And management gave some reasons for that flat underlying PBT in Q4.
They did. Pointed to the lower IRM volumes hitting the established businesses and also increased borrowing costs impacting profitability.
Okay, so a mix of factors. And that affected EBITDA for established businesses too.
Yes, lower IRM volumes were the main drag on established business EBITDA, although the strong mining services performance provided a partial offset.
It really shows how the different parts of AEL's portfolio interact, doesn't it? Some segments up, some down.
Exactly. Looking at the segment details for Q4, ADANIENT ecosystem saw income and EBITDA rise thanks to higher module and WTG sales.
Mining services, as we discussed, strong growth in both income and EBITDA due to higher volumes.
Right. IRM, conversely, saw income and EBITDA fall because of those lower volumes.
At airports.
Airports showed growth in income and EBITDA year-on-year, driven by more passengers and a better customer mix, though they did note a slight sequential dip, maybe seasonal effects on non-aero revenues.
Okay. Now, what about debt? It's increased, right?
It has. As of March 2025, gross debt stood at 762 billion, up from 501 billion the year before. Net external debt also rose to 493 billion.
And do we know where that debt is being used?
The presentation gives a breakdown. You see debt allocated to specific projects: the new copper smelter, IRM working capital, mining services expansion, their Australian projects, defense, shipping, renewables in Australia, plus corporate debt.
So largely project-related debt to fund growth in new ventures. Evaluating the returns on those investments becomes key.
Precisely. It's about assessing whether the debt is being deployed productively.
All right, let's switch focus to ESG, environmental, social, and governance. Seems like a growing area of emphasis for AEL.
Definitely. We mentioned the CDP rating upgrade to A leadership. They also got that strong rating from ESG risk assessment and insight.
And a high ranking in the DJSI assessment.
Yeah. Top 5 globally in their sector, according to the 2024 DJSI CSA, placed in the 97th percentile overall, and actually got the top score 100th percentile in the social dimension.
Those are pretty strong external validations. What about their specific commitments?
They've outlined several key ones: aiming for no net loss to biodiversity, becoming net water positive, ambitious targets for airports and data centers to hit operational net zero by 2029 and 2030, respectively.
And focusing on community value and safety.
Right. Creating shared value and aiming for zero harm across operations are stated goals.
Are they showing tangible progress on environmental metrics?
They reported some significant reductions: 34% drop in water consumption intensity, an 80% cut in absolute Scope 1 emissions, and also reductions in Scope 1 plus 2 combined.
That's encouraging. And social initiatives.
They highlight work in areas like women's education and health, ecological projects, local infrastructure development aligning with UN Sustainable Development Goals.
Okay, and the G in ESG governance.
Seems robust on paper. They point to high board independence, various committees covering responsibility, CSR, nominations, audit, strong oversight processes, risk management, and policies for related party transactions.
So ticking the boxes on governance structure. Good. Finally, let's touch on the management commentary and outlook. What were the key messages?
Management really framed the FY25 performance as a validation of their whole incubation model. They stressed strong execution backed by those credit rating upgrades and their focus on getting projects done on time.
Did they give specifics on the FY26 CapEx plan?
It was discussed in the investor call, but the details weren't in the main presentation or release. So for specifics on spending plans, you'd need to check the call transcript.
Got it. Anything else from the management discussion?
They addressed the tax impact of the Wilmar stake sale, estimating about $6.5 billion extra tax from that gain.
Okay. And reiterated the solar plans.
Yep, reaffirmed the goal for that 10 GW integrated solar ecosystem, expressed confidence in sales despite some export uncertainties, citing existing contracts.
What about mining and airports outlook?
For coal mining services, they stuck to the outlook of reaching around 60 million tons volume in the next 18 months. And for airports, reiterated the plan to start Navi Mumbai Phase 2 right after Phase 1 stabilizes.
And the Mumbai tariff order.
Expected by June. They also noted they can use a provisional tariff for Navi Mumbai initially until final orders come through.
Okay, so wrapping this up, if we summarize this deep dive into Adani Enterprises Q4 and full year FY25, what are the main takeaways?
Well, I think it clearly shows their incubation model is delivering significant growth, especially in those core infrastructure areas. Execution looks strong, reflected in the ratings and project progress.
But there are nuances, right?
Yeah.
Established businesses face some pressure from lower IRM volumes and higher borrowing costs.
True. It wasn't uniform growth across the board. But overall, financial stability seems pretty solid, helped by that Wilmar gain and the momentum in incubating sectors like green hydrogen and airports.
And the growing focus on sustainability and ESG is definitely notable.
Absolutely. Improved ratings, reported emission cuts. It's clearly part of their narrative now. They remain a central player in India's whole infrastructure story.
That incubation model has certainly proven itself over time, and the current pipeline looks like it could continue that pattern.
Seems like the strategy they're sticking with.
For those of you listening who want to dig even deeper, we definitely recommend checking out the full investor presentation and the Q4 FY25 earnings call transcript. You should find those on the Adani Enterprises website.
Yeah, lots more detail in those documents. And maybe here's a final thought to leave you with.
Go for it.
Given AEL's really diverse portfolio, energy, transport, industry, and this clear focus on building out emerging infrastructure, what do you see as the most significant potential growth drivers for them as they move into their next phase? Where will the biggest impact come from?
Something to ponder. Thanks for joining us for this deep dive. We'll catch you on the next one.